If you've been paying attention, you know that it's a very difficult time for investors right now, and that's especially true if you are retired or nearing retirement. It's undoubtedly causing at least a little bit of anxiety, and so you may wonder, what exactly does this mean for you and your income? So, if I may make a suggestion, there is something that is really important to look at right now, and it's not the daily movements of the markets or even your account statement, although that's going to be an important piece of information, perhaps, in what we look at. But I think there's a step that you can actually take that can really help you through times like this. And whether it's this time right now or the next time, whenever that happens to be, this is a tip that can help you get through these events. Now, the market downturn is certainly a problem, especially for people who are in retirement or near retirement. And of course, that's because as the markets go down and you're taking withdrawals, each withdrawal takes a bigger bite out of your portfolio and makes it a little bit more difficult to sustain a lifetime income. That's called the sequence of return risk that you've probably heard about. Younger investors might welcome this type of volatility or these downturns because they're still adding money to their investments. And when prices go down, that helps them out. They can buy more with each salary deferral out of their paycheck or each Roth contribution that they make. But for you, this could be a little bit more difficult. And to complicate things, even conservative investors have seen some surprising losses, and that's because both bonds and stocks have gone down at the same time. So we typically expect those bonds to provide some ballast and maybe offset some of the ups and downs in the stock market, but this time, at least early in the year, it hasn't necessarily been the case. And a 60-40 portfolio, for example, has suffered quite a bit. Bond holdings have suffered. So it is really a difficult period. If that's what it feels like, it is unusual. So here's what I would suggest. If you are feeling anxious about this, take stock of exactly where you are right now, review your retirement plan, and see what the impact of these events has been so far. This is what I do with my most skittish clients, and we can look at exactly where they are and what they're trying to do. And in some cases, we find that this hasn't really derailed them, that they're actually going to be okay. If a plan was built to account for these types of events, and we never know when they're going to occur or why they're going to occur, but it is wise to assume that they will probably occur at some point, and here one is, then the plan can often absorb this type of event. And if that's the case, you might be looking relatively good right now, even though the account statements are kind of ugly, and even though the headlines are very ugly, you might be in reasonably decent shape. Now, if that's not the case, it may be time for some modest adjustments, tweaking some dials here or there, or you might even need to make some dramatic changes. Hopefully, that's not the case, but either way, the sooner you know where you stand, the better off you are. So as you go through this process, go ahead and update those balances in your retirement plan if they don't automatically get updated through a feed or something like that. And maybe consider shaving off a little bit more if you want to assume that things could head farther south if you're going to do a more pessimistic type scenario. Now, remember that we've been through a pretty difficult time, and anything is possible, really anything is possible. We could go much lower, we could rebound, we could kind of churn sideways for a while. I mean, anything is possible. But after a difficult period like this, think about, well, do I think it's really likely that that will repeat? Will we have another 50% loss after what I've been through or not? This is ultimately something that you would decide or work through with your financial planner, but go ahead and update those balances and take a look at where things stand. We've also got inflation, so that might be something to update in your plan. Now, I don't know if high inflation is going to last for the rest of your life. I'm not sure I would bet on that. Again, anything is possible. My crystal ball is broken at the moment, but be careful about assuming that we're going to have, let's say, high or double-digit inflation for decades, especially if you're in your 50s or 60s, something like that. That could end up dramatically altering how your plan looks. So maybe do some what-if scenarios. You can go ahead and evaluate that. And then, maybe just for giggles, look at a scenario where inflation is not quite as dramatic. Once you have some clarity on your situation, then the next steps might become clear. And hopefully, the answer is that yes, you did build a resilient plan that is able to absorb this type of event. And of course, more could come later. But that's good news if you don't need to make major changes right now. And that could very well be the case, especially if you're relatively well off or if you've just done a nice job of preparing for things like this. But if that's not the case, then it's time to start looking at some difficult decisions. Now, hopefully, any adjustments you need to make would be temporary. Let's hope that. But the specific actions are going to vary from person to person. As just one example, this is ultimately going to sound like spending less, and the fact is that it is, because that can help you reduce the withdrawals you take and the impact on your portfolio. But you could consider skipping your inflation adjustments for a year or two or whatever the case may be. And yes, that is taking out less and spending less. But if you think about it as a rule or as a systematic adjustment, it may seem more temporary because we're skipping inflation adjustments during difficult years, but in good years, perhaps you can resume those inflation adjustments and continue a more generous withdrawal rate. Ultimately, all of these fixes and adjustments are more than I can get into in a short video like this. But what I want you to know is that once you understand your situation, once you take stock and take a look at does it affect you and how much and how so, then that's a good first step that can help you start either feeling better or moving towards whatever it's going to take to feel better about how things are right now. Thanks for watching and take care.